Loan cars, also known as car loans, have become increasingly popular in today's fast-paced world, where owning a vehicle is often seen as a necessity rather than a luxury. They offer a path to owning a new or used vehicle without paying the full price up front, making it accessible for many who might otherwise be unable to afford it. This can be tempting, especially for those who need a car but lack the savings for a cash purchase. The allure of driving away in a shiny new car can be hard to resist. However, before you sign on the dotted line, it's crucial to understand the full financial picture. A car loan is a significant financial commitment that extends beyond the initial excitement of acquiring a new vehicle. Loan cars come with various hidden costs that can catch you off guard. These costs can include interest rates, insurance premiums, maintenance fees, and other unexpected expenses. Many people focus solely on the monthly payment, but this is just the tip of the iceberg. The true cost of owning a car on loan can be much higher when you factor in all the additional expenses. Hidden costs can add up quickly, turning your dream car into a financial burden. It's essential to consider the long-term financial impact and not just the immediate gratification. This essay will delve into these hidden costs, empowering you to make informed decisions about loan cars. By understanding the full scope of the financial commitment, you can better prepare and avoid unpleasant surprises. Understanding these costs will help you budget effectively and avoid potential financial pitfalls. With careful planning and consideration, you can enjoy the benefits of owning a car without compromising your financial stability. Before you even hit the road, you'll encounter some upfront costs associated with loan cars. These initial expenses can sometimes catch you off guard if you're not prepared. These costs are often unavoidable but can vary significantly depending on the lender and dealership you choose. It's essential to shop around and compare different offers to find the best deal. The most obvious upfront cost is the down payment. This is a lump sum you pay at the beginning of your loan term. A larger down payment will reduce your loan amount and consequently your monthly payments. This can make your car loan more manageable over time. However, it also requires a significant upfront investment, which can be a financial strain for some buyers. It's crucial to balance your initial payment with your long-term financial health. Then there are processing fees, documentation fees, and other administrative charges. These can add up quickly and should not be overlooked. These fees can range from a few hundred to over $1,000, depending on the dealership and the specifics of your loan agreement. Make sure to inquire about these fees up front and factor them into your budget. Knowing these costs ahead of time can help you avoid any unpleasant surprises. Don't be afraid to negotiate with the dealership. They might be willing to waive or reduce some fees. Effective negotiation can save you a considerable amount of money. Remember, knowledge is power when it comes to negotiating a good deal. The more informed you are, the better equipped you'll be to secure favorable terms and conditions for your car loan. Once you've driven your new car off the lot, the hidden costs don't disappear. In fact, some of the most significant expenses are related to maintenance. Regular servicing, oil changes, tire rotations, and brake replacements are essential for keeping your car running smoothly. These costs can fluctuate depending on the make and model of your vehicle. Moreover, unexpected repairs can crop up at any time. A faulty alternator, a cracked windshield, or even a minor fender bender can set you back hundreds if not thousands of dollars. It's wise to create an emergency fund specifically for car repairs. Having this financial cushion can prevent a sudden repair from derailing your budget. Car insurance is another unavoidable cost associated with owning a vehicle, especially a financed one. It's a necessary expense that ensures you're covered in case of accidents, theft, or other unforeseen events. Lenders typically require comprehensive and collision coverage to protect their investment, which can increase your insurance premiums. This type of coverage not only protects the lender, but also provides you with peace of mind, knowing that your vehicle is covered in a wide range of scenarios. The type of car you drive also influences your insurance rates. Vehicles with higher safety ratings might lower your premiums, while those with higher theft rates or expensive repair costs can drive them up. Sports cars and luxury vehicles tend to have higher premiums due to their increased value and potential repair costs. These vehicles are often more expensive to repair or replace, making them riskier for insurance companies. Your driving history, age, and location also play a role in determining your insurance premiums. Younger drivers or those with a history of accidents may face higher rates, while living in an area with high traffic or crime can also impact your costs. It's crucial to shop around for car insurance quotes from different providers. Comparing quotes can help you find the most affordable option that still offers the coverage you need. Compare coverage options and deductibles to find the best balance between cost and protection. Understanding the details of each policy can help you make an informed decision. Don't be afraid to ask about discounts for safe driving, bundling policies, or having safety features installed in your car. Many insurance companies offer discounts that can significantly reduce your premiums, making it more affordable to protect your ride. Depreciation is a silent killer when it comes to car ownership. It refers to the decrease in a car's value over time due to wear and tear, mileage, and age. New cars, in particular, experience a significant drop in value within the first few years of ownership. This is important to consider, especially if you plan to sell or trade in your car in the future. While you can't completely avoid depreciation, you can choose cars that tend to hold their value better. Research different makes and models, their reliability records, and their resale values. Opting for a car with a slower depreciation rate can save you money in the long run. Fuel costs are an ongoing expense that can fluctuate significantly depending on gas prices. The type of car you drive, your daily commute, and your driving habits all contribute to your fuel consumption. Fuel-efficient vehicles, such as hybrids or electric cars, can help you save money on gas. However, they often come with a higher purchase price. Consider carpooling, using public transportation, or biking for shorter trips to reduce your fuel consumption. Maintaining your car regularly, including keeping your tires properly inflated, can also improve your gas mileage. Small changes in your driving habits, such as avoiding rapid acceleration and braking, can also make a difference. Loan agreements often come with a slew of hidden fees and charges that can catch you off guard. Late payment fees, prepayment penalties, and loan origination fees are just a few examples. These fees can add up quickly and increase the overall cost of your loan. Read the fine print of your loan agreement carefully, paying attention to any fees or charges that are mentioned. Don't be afraid to ask your lender to clarify any terms or conditions you don't understand. If a particular fee seems excessive or unreasonable, don't hesitate to negotiate with the lender. When you take out a loan car, you're essentially borrowing money to purchase the vehicle. The lender charges interest on this loan, which is how they make a profit. The interest rate you qualify for depends on factors such as your credit score, loan term, and the lender's policies. A higher interest rate means you'll pay more over the life of the loan. To secure a favorable interest rate, it's essential to maintain a good credit score. Shop around for loan quotes from different lenders, comparing interest rates, loan terms, and fees. Consider making a larger down payment to reduce the loan amount and potentially qualify for a lower interest rate. While it's great to pay off your loan car early and free yourself from monthly payments, some loan agreements come with early termination penalties. These penalties are designed to compensate the lender for the interest they would have earned if you had continued making payments for the full loan term. Before signing a loan agreement, inquire about any early termination penalties and factor them into your decision. If you're unsure about your ability to commit to the full loan term, it might be worth considering a shorter loan term or exploring other financing options. While the hidden costs of loan cars can seem daunting, there are ways to minimize their impact on your finances. Start by creating a realistic budget that includes all potential expenses, not just the monthly payment. Shop around for the best loan rates and insurance premiums to secure the most favorable terms. Consider buying a used car instead of a new one to avoid the steep depreciation hit. Maintain your car regularly to prevent costly repairs and improve fuel efficiency. Finally, drive safely and responsibly to avoid accidents and traffic violations that can increase your insurance premiums. Loan cars can be a convenient way to acquire a vehicle, but it's crucial to approach them with a clear understanding of the hidden costs involved. By factoring in expenses like maintenance, insurance, depreciation, and interest, you can make informed decisions that align with your financial goals. Remember, the true cost of a car extends far beyond the monthly payment. Take your time, do your research, and don't be afraid to negotiate to secure the best possible deal. By being proactive and informed, you can enjoy the convenience of a car without derailing your financial well-being.